It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and this is our hour to talk taxes. And so if you're on your way to church and you're listening and you got a question, you say, you know what, Ethel, we're going to get to the bottom of that tomorrow. Hey, you can call us right now. We want to give you some free tax help. I'm Esther Gulius, the Tax Lady from EG Tax. All of our offices are open 9 to 9 Monday through Friday, 9 to 5 on Saturday. Same thing if you're in Arizona or if you're in Florida on Airport Pulling Road. And I got Chris Fabian with us here in studio. Hey, Chris.
Hello,
Isn't
Esther.
it good to be out on a Saturday?
It is.
And
It is.
sunny.
And it's sunny. The sky is blue.
Yes.
You know,
it's
can't
wonderful.
complain.
And I just want to wish everybody a wonderful Easter. I hope you have a great time with your
Yes.
family. And remember the reason that it's Easter Sunday, and we just are thankful for that. aren't we?
Amen.
Okay, we want to talk about something else that we're thankful for is taxes and our clients and how we want to help
thankful
them.
for our clients.
Right, because we help them with taxes, right? And so look at the bottom line is you got let's 3 weeks, a little over 3 weeks, and the jig is up. So if you're sitting there and you owe money and you know who you are and you don't know what to do, we thought our conversation today would be about what to do or what to watch out for if you can't pay. The first thing you should do if you owe money is make sure you double check all your deductions.
Yeah, double check your return. Make sure everything's. I mean, you should do that anyways. No matter if we prepare it, Bob Smith prepares it. Double check the return. Make sure everything's right.
Right. And, you know, the other thing is where you put your income has a lot to do with how much it's taxed.
Yep.
Like, for instance, if you're somebody who has capital gains distributions, qualified distributions, if you just don't do the Schedule D worksheet, you will overpay. So those are things you should do is double check your deductions, double check the way the return was, make sure all the income is in the right place, because you can facilitate a change in the positive, hopefully.
Right. How about your filing status, too? A simple thing is your
That's right.
filing status.
Which isn't simple at all.
No,
right?
Not at all.
This other thing is make sure that you timely file the return, because there's a failure to file penalty. You didn't file the return, they're going to assess you up to 25% on the balance due, and a failure to pay penalty, which again incrementally goes up. The first one goes up at 5% a month until it hits 25. The second one goes up 0.05% a month. So it's the failure to pay penalty is much less than the failure to file penalty.
Right.
So you want to timely file the return, and then you can work it out with them.
Exactly.
Right?
Yep.
Because that's a big penalty to avoid. The third thing is get as much money together to pay as much of the liability as you possibly can. So let's say you owe $4,000. The worst thing you can do is say, okay, I'm just not going to deal with it until they bill me. If you can scrape together $1,500 or $2,000, then what they bill you is what's left.
The interest
Failure to pay penalty would be on that smaller figure, which is so important. And you can also put it on a credit card.
Right. You can. You know, if you have a 0% credit card out there,
hey,
no brainer.
And the fees for the credit card are deductible next year.
Yeah.
Because that's the cost of you dealing with your tax liability. So those are just three of those things. We got a whole big list. Again, if you have any questions, if you're wrestling with your tax return, if you have gotten a love letter, you haven't gotten your refund, you're somebody that's been struggling with the Obamacare issue, give us a call in studio, 803-0930, 803-0930, star 930 on a cell phone. If you're listening on WGUF in Florida, we are 1 hour earlier than you, so you'd have to call an hour earlier next week if you wanted to be on the show with us. And again, our toll-free number is 1-800-616-WBEN, and we're going to go to the phones and talk to Ed and Tonawanda. Hey, Mr. Ed, how you doing?
Good. Got a question for you.
Yeah.
I'm turning 70 and a half. Have to start taking the money out of my 457.
Yep.
and this year it's going to be approximately $16,000.
Okay.
Now, my question is, if I got some paperwork from the state and it says that they'll give me the $16,000 in December, and they'll take 10% out for taxes.
Okay.
Now, should I have more money taken out of my regular pension during the year to compensate for the taxes, or should I just let them take out that 10% at the end of the year?
Okay, so here's the thing. Your regular pension, it sounds like you're retired on a New York State pension.
Right.
Okay, so you probably have a sizable pension.
Well, my taxable income is about $37,000.
Okay, are you married or single?
Single.
All right, so here's the thing. Your Social Security is definitely going to be 85% taxable. So
Right.
not only is your RMD going to be more, your Social Security may be more taxable. So now it looks like you're taking more out than you actually did. I don't know that 10% is going to be enough. So I think what you should do is project next year's tax return as if you have that money, and double check to see what your how much the RMD is going to affect your Social Security, because you may need 15%
Or even
without,
20.
or 20.
Well, I kind of figured that out. I figured if I let it go to the very end of the year, they'll have to take out 18% on that 16,000.
No, but
Right, to break out even.
Right.
Right.
Yeah,
Break
so
out even.
yeah, so you can tell them to do 18% right out of your withholding. There, you can increase your monthly pension. You could take it out of your Social Security. The government doesn't care what hand it comes
Right,
from,
absolutely.
as long as it comes in.
But don't take any more out of your regular pension, because then it's going to be more taxable. So use your RMD, have more withheld out of your RMD,
At
so
the
it'll
end of the
cover
year.
the liability.
Yep.
Okay?
Oh, at the end of the year, you mean?
Yes.
Yeah.
Okay, all right. All right, thank you.
All right, Ed, thank you. I'm Esther Golias, the tax lady from EG Tax. If you have any questions, want to join us here in studio, we'd love to hear what you have to say. 803-0930, 803-0930, star 930 on a cell phone. So we're going to take a short break. We'll see you on the other side.
Tell me that you've got everything you want.
I don't know who that is,
Back
Tyler.
and sing, but you don't get
That's a Beatles?
Yeah, I was going to say that's.
How would I know that that's not a Beatles song? I'm Esther Golias, the tax lady from EG Tax. Give us a call if you got a tax question. We want to help you. We're talking today about what if you do if you can't pay, your tax liability. Another thing you could do is take out a home equity credit loan on your house. I mean, I'm going to tell you something. You want to make sure that you pay your liability, and a home equity credit line is great because
Then it's deductible.
and it's low interest.
Yep.
Right? So that's another thing you can do. Sell something. I mean, if you got stocks, sell your stocks.
Yep.
I wouldn't take money out of my IRA and pension plan if I had to. But I mean, selling something. Maybe you got that, whatever, second car in the garage that you don't need or whatever. I mean, getting the asset, the money to get the IRS off your back is a really important thing. And obviously, change your W-4 and change your withholding
So it
doesn't
doesn't
happen
happen
next
again.
year.
Yep.
Okay. Master Golias, the tax lady, 803-0930, 803-0930, star 930 on a cell phone. We're going to go to Richard, who's been holding and waiting for so long. Hi, Rich. How can we help you?
Yeah, the question is, when you take Social Security early at 62, how much can you earn each year for 2015 before you have to pay back some?
It's just about 15.5.
15.5.
Right. And then you'd have to pay back $1 for every $2 you make over that. So
Okay, will that be the same for 2016 also?
yeah, until you turn 65, and then it's limitless. Then
Yeah,
you can
it may go up every year a little because it used to be 13,000, then 14,000, so it goes up a little each year.
Okay, thank you very
because
much.
you never know what they're going to do.
Okay.
Okay?
Yep, thank you.
Thank you. I'm Esther Golias, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on a cell phone, and we're going to Kevin from Clarence. Hi, Kev.
Oh, yes, hello?
Hi.
Oh, hello. So, I just left my job. Okay, I have a 401k. I'm 28 years old, and I was recently hired by Erie County.
Okay.
Okay. And I just don't know what to do with my old 401k.
Well, are they? Is the employer telling you to take it out?
I'm not sure. No one is telling me anything.
All right. So if your employer, well, first of all, if it's performing well and the former employer says that you can keep it there and that's what you want to do, then you don't have to do anything. If, however, you want to control it, then they can take it out. Right?
Then you can move it. You can
Roll it over.
roll it over to an IRA. You can ask Erie. You said Erie County, right?
Correct.
You can ask Erie County if you could open up a 403B and roll it right over to 403B. Sometimes one employer lets you take over the other, brings over the other's pension plan. So either the IRA or bring it to like a 403B plan at the county level.
Right. So just make sure, Kevin, if you take it and they send you the check, you have to do this rollover within 60 days into a qualified retirement plan, whether it be an IRA or the retirement plan through Erie County.
Oh, I see. And just one quick question. If I leave it in the Vanguard, are there fees, a lot of fees I have to worry about?
It all depends on what the plan is doing right now. So you want to take a look at what the past performance is,
Okay.
and you can see how it's been performing. And so if it's been doing well and you like what it is, and the employer hasn't said, Kevin, you got to take it out, then you can leave it in there. But don't forget about it. You know, part of what people do is they worked at job A, and now when they're 29, now at 60. They forgot about, a lot of time, a lot of water under the bridge. So you want to make sure that you don't forget about this 401k plan.
Okay.
Okay?
Yep, thank you.
Thanks,
Good
Kevin.
luck.
Yeah, I'm Esther Golias, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on a cell phone. Just wanted to clarify for my caller before, it's if you're under normal retirement age, it's $1 for every $2 you earn. This is, again, wages, over $15,720 through 2016.
Okay.
So that's absolute. So we don't know what it'll be in 17 and
Right.
18. All right. So So you're out there and you owe money, and you don't know how to pay the IRS. What else? If you have a CD.
Yep.
The interest that is accruing on your CD, you're not breaking the CD if you take the interest out. So some people might have some certificates of deposits with some accrued interest on it. They don't have to break the CD. They can take the interest
Right, but
off.
you may also want to look at and see, well, my CD is only giving me 0.5%.
And the IRS is
It's
going to charge me $25.
Yeah, well, so,
That's true.
Cash
Absolutely.
it in.
That's absolutely true. True. The bottom line is nobody likes to owe. But if you do, the last people you want to deal with is the Internal Revenue Service in the state of New York, because it's not deductible interest,
Right.
and it's not very kind to you either. Another thing you can do is set up a payment arrangement. Now, people can actually do that at the time they do their tax return.
Right. Yeah, there's a form you fill out, and you just 41 something, and you just say, I can pay $100 a month on the 20th of every month, and they'll say, okay.
And a phone number to call you,
Yep.
and they may call or they may not, but they'll do an automatic withdrawal from your checking account every month to pay the liability, and they will definitely work with you. There is a fee to set it up, but again, that's another option.
Right.
Right?
Yes.
The other thing is if you're somebody that has wages and you aren't eliminated from contributing to an IRA because you're under a qualified plan, and your income is low enough, you might be able to use an IRA to your advantage.
Right.
Correct? So if it's husband and wife working and they're over the age of, they're 50 or older, they could put $13,000 away in an IRA. And if you're in the 20% bracket, it saves you $2,600. So that's one way to get rid of your liability.
Right. I had someone this week, a couple days ago, their broker told them, put it in a Roth. And so I put it in the Roth, and back my mind's going like crazy, and I did the return. I said, oh, you guys owe $400. They go, what? I said, well, wait a minute. Let's, that money he said to put in a Roth that you did, let's recharacterize it to now you're getting back $2,300.
Oh.
Huh?
Right.
Why would he tell me to put it in a Roth then?
Because and especially if you're somebody that's in your own pension plan and you're the only one going to be contributed to it, most people or many people will not get any benefit at all from using a Roth because it's not going to be taxable as a traditional IRA anyway.
That's what I explained to. I said, look at your income. You have no government job. You have no pension. You have your 401k. So when you're 70 years old, what are you going to live on? And they go, well, Social Security and my pension, my 401k. I said, exactly. But if you only take out the minimum, you won't even have to file. So the money,
especially if it's a number of years from now,
right.
They keep upping the ante every year, so it goes up higher and higher and higher. And you're almost $22,000 this year.
As a married couple,
couple before you have to pay taxes. So if you had $10,000 coming out of your IRA, you wouldn't pay any taxes on it. So if you had a Roth, you didn't get the deduction when you put it in, and you don't have the taxes when it's coming out, you haven't won a thing.
Right, and that's they go, well, why would he? I said, well, do you have kids? And I said, no. They said no. And I said, well, usually their reasoning is, well, then the person who inherits it doesn't pay tax. But they go, who cares? We're dead. I said, exactly. Save the money now.
Right. And that's the other thing is you really it comes down to like playing chess. You have to strategize and see. You have to look at this angle and that angle, and you use your best guesstimate. But obviously you're alive now, and so your liabilities now, and so you want to take a look at that. So that's another thing. Are you self-employed? If you're self-employed and you have a net profit, not only could you contribute to an IRA, you could set up an SEP and put up to 25% of your net profit away. I had a realtor yesterday that was a very successful realtor, and we were able to put away $30,000 in her SEP. And the really cool thing is she has a liability due April the 15th, so we're paying the liability and extending
the due date
of the paperwork till October the 15th,
which then allows
her the time to put the $30,000 in the SEP. So I mean, those are things you want to do if you're somebody that when you're getting ready for tax time this time of year, you look at all the angles. And if you need help, you can give us a call at EG Tax or email us through our website at egtax.com because we certainly want to help you. Right?
Definitely.
I'm Esther Gulius, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on a cell phone. Our toll-free number is 1-800-616-WBEN. Yes, sir.
And then, if you're in this situation, too, like we said, change your withholding so it doesn't happen. But if you're in that situation where 4 years in a row went by and now you owe $15,000, $20,000 to the government and you're lost, confused, we can help.
Yep.
We can do those offers and compromises for you for, like the commercial says, pennies on the dollar. But our fees are more reasonable. We know we can work. We've done them through New York State.
So here's what an offer and compromise is. So you find out that you owe a lot of money. Something you made a tragic decision. You took $100,000 out of your IRA, and you're under the age of 59 and a half, so you owe all the taxes plus the penalties. An offer and compromise is where we basically, and you're unable to pay the liability, where we basically take a look at what your expenses are and what your income is, and if you truly are unable to pay the liability, as opposed to putting your head in the sand and saying, I just don't know what to do, we proactively say to the IRS, hey, see, this person doesn't have the money to pay you, can't afford to pay you, and so you make an offer to compromise the amount of money that you do owe them, and you'd be surprised. You will owe, in most situations, pennies on the dollar. And of course you have to be square with the IRS for 5 years or the liability comes back. But it's a remarkable program, and if you're somebody that's been out there struggling to pay the IRS, not just this year, for other years, if you have had outstanding liabilities, unless you're in a non-collectible status, right?
Right.
We can help you. We help people that haven't filed their tax returns in like 10 years. And I'm going to tell you something. If you haven't filed your tax return in 10 years and they haven't been bothering you, then what's the reason they haven't been bothering you?
Because you had money coming back that you just lost.
Right. They're keeping your money.
Yes.
Because if you say, well, I don't know, they just don't bother me, well, that's because you have money coming back. And so sometimes it's just like unblocking the mental block.
Yes.
I mean, people just have this mental
the
block
fear.
about
It's a fear.
Yeah, but some people say to me, "Oh my God, I worried all morning before I got here. I don't know why I worry, but I worry every year, because it's fear of the unknown." Last thing, if you find out that you owe money that you can't pay, here's a humbling one: ask your family members for a loan.
Yes.
Because that's usually very inexpensive. And, again, you can get that liability paid for. The important thing is you want to get the old liability paid for and make sure it doesn't happen again next year.
Right? Yes, definitely.
I'm Esther Gulias, the tax lady from EG Tax, 803-0930. 803-0930, star 930 on a cell phone. Our toll-free number out of town is 1-800-616-WBEN. And, all right, we also want to talk about common mistakes people make. I know there's people on the phone here waiting. We'll get to you in a second, but not claiming dependents, right?
Yep.
You may have somebody living in your house that's not even a relative, who lived with you all year. Maybe it's your boyfriend's girlfriend. No, you're not your boyfriend's girlfriend. That would be
not.
very strange.
Your son's girlfriend.
And lived there all year, didn't work,
Yep.
or maybe she's going to school. If she lived in your house, didn't have income over $4,000 taxable income, you supported her, she's your dependent.
Right.
If she's a U.S. citizen and resident of the United States.
Not a Russian mail-in bride.
Not a Russian mail-in bride. I mean, you would be surprised. Maybe you have your mother living in your house.
Yes.
And maybe many times I say to people, how much money does mom have to live on? And they say, oh, I don't want to ask. Sometimes it's best to have those kind of frank discussions because you got, it can save you a lot of money.
Could save, yes.
Right?
Definitely.
Okay, we're going to take a short break for news. I'm Esther Gulias, the tax lady, 803-0930, 803-0930, star 930 on cell phone. We'll be back on the other side with your questions.
Oh, darling, please believe me.
I didn't cheat on my taxes.
Now, who is that?
Sir Paul.
That's Paul McCartney?
Yes, indeed.
Wow. Well, I'm Esther Gulias, who doesn't know anything about music, but I know a thing or two about taxes, and I want to help you. 803-0930, 803-0930. We're talking about common mistakes people make on their tax returns. We better talk to Tom, who's been waiting for so long. Mr. Tom, how can we talk to you and help you, sir?
Good evening, good afternoon, tax lady.
Hey.
It is 60 and sunny in Boston. How's your weather out there?
Great. You're Boston, like Boston, Mass?
Yes, ma'am, where I park the car in the yard.
On the North Shore?
On the North Shore and put my clothes in my drawer.
One time I was in Boston, and we were talking about offices, where to put them, and this lady said to me, "You need to go to the North Shore." And I says, "To the North Shore?" And I'm thinking NASHW, North Shore, right? But she was saying North Shore. So anyway, so what can we help you with, Tom?
We talk like we have a mouthful of marbles, huh?
Yeah, that's right. I love accents. So what kind of question?
I want to get your verification, and if you can add to this. I was listening to what you call underhanded or non-legitimate people, and one of them was trying to do taxes, and here's the red flag according to what I heard. If they refuse to sign it and they ask for a percentage of the tax, no matter what they look like, those are two giant red flags that something's not right.
What do you think, Tom?
Well,
right off.
I know they were grimy, but what can you add to that other than those two red flags?
I would not let that person do my return.
Yeah. First of all, it's illegal on an original return to charge a percentage of the refund.
Right. You can charge a percentage on an amended.
Correct.
But you cannot on the original refund. And the person that did the return needs to have a tax preparer ID number, a PTIN, and sign the return.
Correct. Other than those two obvious red flags, is there any other what you call less obvious indicators that you should be wary
Well,
of?
I think
if they ask
somebody's-
if you want to add a child to your tax return.
Right, if somebody's saying, hey, I have some extra Social Security numbers here, would you like to get some more money, and I'll get you the earned income credit, that would be another one. I mean, anytime somebody's suggesting something that you know isn't right, you know, they're adding children,
Or-
they're making up deductions. I had a client the other day that the preparer that they had added an extra $10,000 in charitable contributions that they used last year. And, you know, when I did the return this year, I said, wow, your contributions really are a lot less. And she said, no, they're not. They're the same as they were the year before. And I said, well, no. This is what your return says from last year. And she was not even aware of it, because had he not put the $10,000 in itemized deductions, she would have owed, and maybe he was trying to win her over. I don't know. I have no idea. But if somebody's padding your return with deductions, putting people on that aren't your dependents, don't want to sign the return, asking for a percentage, you should run.
Correct. Those are the fly-by-night sleazy Sam services, right?
Right. But we know in
correct.
Boston they would never do that, right, Tom?
Absolutely not. We are pious and righteous and pure.
That's right. Well, thanks for calling. You have a great Easter, Tom.
Thank you, ma'am. You too.
Thank you. I'm Esther Golias, the tax lady from EG Tax. You certainly don't want to do business with somebody like that, right? You want somebody this is what I always say to people. If they want to do something that, something gray where I would have something to hang my hat on, that would be something that I would say to them. Now, you have to understand this is something we'd have to substantiate. You have all the proof, da-da-da-da. But something where it's absolutely wrong, you don't want to do business with somebody like that, because what's going to happen is if you get audited, you could have stayed home and cheated yourself.
Yep.
You don't.
One of my lines I tell my clients when there's something, a single person with 2 babies at home, and they say they're single with $4,000 and no public assistance, nothing, I'll say, well, would you rather me ask you all these questions now, or would you rather the IRS, who will take everything away for 10 years and you won't see any earned? Oh, well, you go ahead. Okay, my boyfriend actually lives there, and
Right.
and you show them. Just because single to had a household, that didn't change anything.
When I'm doing a tax return, just like you, Chris, I want to make sure that I don't want these people to get audited.
Yep.
So I try to say, now, are you aware of such and such? Have you done this? Do you have this contribution, this? And it's because I don't want them to get into trouble, right?
Yep.
Okay, I'm Esther Golias, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on a cell phone. Other things that people make mistakes is not claiming education credits, right?
Yep, not claiming the right one either.
Right. Why would a parent not want to claim an education credit for their child?
Because their child already went out and claimed their own exemption on their own return.
Right. And so, but is that an irreparable... Is that something that can't be fixed?
It can definitely be fixed.
It can be. So all you have to do is amend the child's return. The parent's going to pay a little bit back for the child on the child's return, but the parents will probably get around $3,000.
Right.
Right.
Yep.
So if your child has done even if the child has the student loans in their name, the parents should still claim the education credit and the child.
Definitely.
Right. And if you have been letting this go for a number of years, we can amend that return and get you your money back. Another thing is not using the 2441 when you have daycare, the $5,000 maximum daycare taken out on pre-tax on your W-2. Because if you don't use the 2441 to explain that that's where the money went, it ends up getting taxable.
Yes. Yep.
Right?
Oh, it does. It does, because you got to prove that the money was spent. Otherwise, they add it back. We had someone today where they put in the $5,000 through the dependent care benefits, and she's like, I don't know if it's worth it. I have such a hard time because the daycare's so expensive, and I have to prepay the daycare, then fight to get it back through this. And so I showed her the math. I said, well, by doing the daycare benefit at work, you save $2,000 in taxes between federal, state, and Social Security. I said, now, if you don't want to do that and you just want that credit on the tax return, you're only going to save $720 between federal
state and federal.
Right.
Yeah.
So you actually save $1,300 by.
Extra.
She goes, It's worth it.
It is worth it. And I think people don't realize that daycare benefit through your employer does save you the FICA as well. So it's the FICA plus the $5,000 maximum, which is more than they're going to give you
on the 2441
return. So if you're somebody that has that daycare benefit available to you and you have children that are in daycare, that's a great tip. Okay, another thing that people do is they confuse a capital improvement with the energy credit. Do people ever say to you, "Oh, I have a capital improvement"?
Oh, I did my kitchen.
Right. And
That's
so
great.
A capital improvement basically means that the state of New York is not going to make you pay sales tax.
Right.
And that's what a capital improvement is. The energy credit means that you've buttoned up your house to make it more fuel efficient.
You replaced old stuff,
right.
Your old
exterior
furnace.
doors, exterior windows with Energy Star.
Yep.
With Energy Star. Now, how about a stove? No, because it's got to be a component part of your house.
Correct. Something that's affixed to the house. When you move, you cannot take it.
And it's got to be the Energy Star highest efficiency furnace. The SEER 97.
Yeah, something
is what you have to do to qualify for the energy credit. And by the way, the energy credit is for next year as well.
Correct.
All right, but don't confuse capital improvement with the energy credit. Not using a Schedule C if you have non-employee compensation. You just put it on line 21. That's not good.
No, not at all.
Because the Schedule C is the form you would use, and from that you would also pay self-employment taxes. If you just put it on line 21, they're going to send you a bill with penalties and interest, and that'll ruin your day, right?
Yep.
I'm Esther Gullius, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on a cell phone, and we're going to go to Frank in Williamsville. Hey, Frank.
Esther, the amount of knowledge that you have about taxes in your group there is incredible. It's just incredible. And my comment is this, though. The example you just used about the lady in the daycare and the $1,100 or $1,300, I'm not sure exactly what it was. There's a lady who's almost willing and ready and frustrated enough. She's willing to turn that money aside because it's so complicated, so complex, so hard and time-consuming, and there's so many misunderstandings that she almost said, heck with the money. I don't have the time or the effort or the will to fill all that stuff out.
I know.
Is there anything that ever is going to be done about that? Because we're all sitting there trying to figure out a tax. We're all scared we're going to do it wrong.
I know.
They're going to audit us, right?
I know.
And then you don't want to be a stupid and take a chance, so you leave money on the table.
I know.
And they say there's billions of dollars unrefunded because people aren't getting it. It's just so it's too hard.
You are absolutely right. Because what they do, Frank, many times is they tweak the tax code, which is already hard, with some kind of an exception. So there's not only the code, but there's all the exceptions to the code under that same portion. Really, they would really have to go back and start from scratch, and that would be interesting. And that's what I think some of the Republicans are talking about doing. To me, it'll be very interesting to see what they do. But you are right; it is very complicated. And the reason that we know so much is that this is what we do day after day after day after day, and it's hard for us too, Frank. So
exactly, you're an expert, and you're probably doubting yourself sometimes.
It's hard for us. There's times, especially now with Obamacare just came in, the
regulations
1095 A, B, and C. It's very difficult because the Internal Revenue Service doesn't even know what to do with them. So, but I appreciate your comments.
But that's one other thing. The other thing is every time they try to change the tax code, it's like a big house of cards because they got all these riders on every bill they put out there, and then it always gets back to the homeowner's deduction for their mortgage interest, and they always say, well, we can't do that. That's like the sacred cow. So then nothing gets done. I mean, somehow or some way we have to set.
Well, it's really I have to say, Frank, it's the middle income taxpayer and the single people and people in the middle are really getting shafted. I can't think of a better word, because they don't get the deductions that people with children and people that are lower income get, because once you hit 100,000, it's like, talk about a sacred cow, they start taking away all your deductions. But you have a great Easter. Thanks for calling, Frank.
Thank you for all your knowledge.
All right, thank you, sir. Bye-bye. I'm Esther Gulius, the tax lady. We're going to take a short break. 8030930 star 930 in a cell phone. We'll see you on the other side. Is that Mario Lanza?
No, it's Bocelli.
Bocelli. I love
For
Andrea
you.
Bocelli. I love Bocelli. I went to see Andrea Bocelli in person one time.
Yes, your husband surprised you.
He did. Oh, gosh, it was so great.
You haven't been the same since.
I haven't. But I haven't gotten any better with music either, have I?
We're working on it.
Well,
Only
no,
been a few
but
years.
You like milkmaids in the bathroom or something. I don't know what game groups you have.
That's
all
not
right. That doesn't even sound good, does it? All right, let's go to Logan. Hey, Logan, how can I help you?
Hi. Good afternoon.
Good
I have a
afternoon.
question.
Yeah.
I'm having custom-made interior window shutters installed into my window sashes inside the house. I have two estimates. One company is charging me sales tax. The other one is not. The one that is not claims it's a permanent fixture and would apparently fall under the home improvement or capital improvement.
Capital improvement, yeah.
Which one is correct?
Well, they would have to have you fill out a capital improvement form and in order for it to qualify. But it has to be permanently affixed to the house and become part of the house. So I can't see the shutters, and I'm not going to pass judgment on it. If you really want an opinion, call New York State Sales Tax Department.
Yep.
You know, and somebody answers the phone and say, if I have shutters attached permanently to my window, who would get in trouble would be the people selling it.
I see.
Okay.
Well, luckily for me, the one that's not charging sales tax is half the price of the one that is. So.
Well, there you go. There you go.
Okay, you answered
All
that
right.
question.
Thanks,
Thank you so
Logan.
much.
Bye. Okay, let's go to, Carol. Hey, Carol, how can we help you?
Yes, I wanted to know if mortgage interest is no longer, you can't any longer take it off your taxes.
No, it's definitely deductible.
No, there was something about seniors. Seniors couldn't.
No. Seniors can still. See, the whole thing is you either itemize or you take the standard deduction, okay? Uh-huh. The standard deduction, once you're a senior, especially if you're filing a joint return, is very high, okay? So you have to rise and get past the standard deduction to be able to itemize, and part of that would be your mortgage interest. So it'd be your deductible medical over 10%, your property taxes, your state and local sales taxes, your mortgage interest, your home equity credit line, your investment interest, your charity, your miscellaneous itemized deduction, your gambling losses if you have gambling income. If those figures are more than the standard deduction, then yes, you can take it. But if it's less than, then you wouldn't take it.
Oh.
Okay?
I have another question.
Yeah.
I heard that you said that you couldn't take, if somebody was living in your home, you could take them off.
Only if they lived in your home for a full year, had taxable income of less than $4,000, we're not filing a joint return, we're a resident of the United States and citizen of the United States.
Okay, well, that leaves me out. Well, thank you so much. And
Okay.
have a blessed Easter.
You too, Carol.
Okay.
Thank you. Yeah, so, of course, they could be a resident of Canada.
And they got to have 2 legs, not 4.
That's true. You can't claim your animals. Right. All right, let's go back to the phone. Hey, Bob, how can we help you? Hello, Bob.
Hello? Oh, yes. Is this Auntie Esther?
This is Auntie Esther. What can she help you with?
I love your program. I listen to you all the time.
Thank you.
And listen, my question is, I have a traditional IRA. I'm turning 70, and I was wondering if there's any advantage of me to start taking those funds and placing them into a Roth IRA for, say, my beneficiaries.
Okay, so here's the thing. How much income do you have right now? Are you living on anything besides your Social Security?
Yes.
May I ask, like, what? I mean, is it
pensions? I have a pension, Social Security, and incomes from stock holdings. And
okay, so here's the thing. If right now, are you married or single, by the way?
Single.
All right. So your standard deduction and personal exemption it'd be about $14,000 before he has to pay taxes.
Right.
So probably you're already paying taxes. Is your Social Security being taxed is your Social Security being taxed right now at 85%?
Yes.
Okay. So if you take money out of your IRA and put it into a Roth, it's going to be fully taxable. So what you have to weigh out is it better for Bob to pay the taxes so his heirs don't pay the taxes, or do you just want to let it ride? Because the amount you're going to take out once you're 70 and a half is going to be a very small amount of money based upon the total amount of money that you have in your IRA. So what you have to put a pencil to it and see if you are happy. If you took $10,000 out, are you happy that you would pay $4,000 in taxes? Only you can make that determination.
Oh, okay. Understand.
All right.
Thank
So
you
if
very
you,
much, Esther.
yeah, and during the summer, if you want to come in, we'll sit down and do all the work for you, and there's no charge.
Oh, great.
Okay.
I'll do that.
All right.
Thank you.
Thank Bob.
All right. Bye-bye.
Bye-bye. And let's see, we got. Wouldn't you agree with
I
that?
would.
Chris?
Yep.
I mean,
yep.
You know what I always do is people say to me, "I think I'm going to do this," and I say, "Okay, here's your tax return. Now watch. I'm going to put in that $10,000 that you said. Now you just went from getting a $500 refund. You now owe to $2,500.
Yep.
How does that make you feel? Well, I don't feel good at all about it. Well, that's what will happen next year. That's what, anyway, let's see. We're going to go back to the phones and talk to Rob. Hey, Rob, how you doing?
I'm doing fine, thank you.
What can we help you with, sir?
My wife and I are retired, and we get Social Security. I have a small pension.
Uh-huh.
Grossing just about $45,000 a year.
All right.
We've had some medical with her the last couple of years, and I need to know what I need percentage-wise, if I need to itemize or if I just take the standard.
Okay, well, how much is the Social Security between you and your wife?
It's $2,300 a month.
Between the two of you?
Yes.
So you're looking times 12, 23,000. You're looking about $27,000. So your pension is about $15,000?
Approximately, yes.
Okay, so really you're not paying tax on the Social Security. So then if there's no other income, you guys aren't even filing, you don't even have any taxable income left after your standard deduction and personal exemption, so there would be no tax return. You don't even have to worry about the itemized deductions.
Right. So I just take whatever.
Yep, because your pension would zero out between the standard deduction and the personal exemptions.
Right, because you're over the age of 65.
Oh, yes, I'm 72.
Right, so what Chris is saying, since your Social Security is not taxable, and the only thing that's taxable is your pension, and that pension is under $22,000, you're not going to pay taxes, whether you itemize or don't itemize.
Okay.
Okay?
Okay.
Thanks, Rob.
Thank you.
Bye-bye. So,
I'm sorry for the medical bills for your wife.
Right.
But it's to go through the headache of doing all the medical, you don't even have to.
It won't even benefit
just trying
you
to
at all.
save you some time.
Right. All right, and then we got Tracy. Hey, Tracy, how can we help you?
Hi, Esther. I wanted to ask you, my mom has a generator. We just had it installed not too long ago, a couple months back. Does that make any difference for her in regarding taxes or even insurance, homeowners insurance?
Well, insurance we can't answer.
Okay.
Taxes, is she on any type of medical equipment that needs a constant energy, like a oxygen machine, anything like that?
No.
So then it wouldn't qualify for the energy credit. So basically, it's a wonderful thing. She's got it for security, but that's all. It's not deductible.
Okay. All right. Thanks so much,
all right,
guys.
Thanks, Tracy.
Okay.
Bye-bye. Happy Easter. That's the whole thing is, you can see in one category it wouldn't be deductible, but maybe it would be deductible as a medical expense, because if she needed constant electric supply to keep medical appliances running, that would be a horse of a different color. So you never know if something you're looking at deduction is going to be a deduction, depending upon what it's used for. And then let's go to Ron in Lancaster. Hey, Ron, how can we help you?
Hi, Esther. I had a gambling debt.
Okay.
And the IRS guaranteed my wife's Social Security.
Okay.
there anything I can do about this?
All right, so you what do you mean? So you owe the IRS money, correct?
I would say approximately $3,800 in taxes on winnings.
All right, are you able to pay the liability?
What do you mean by liability?
The $3,800.
No. We're on Social Security.
All right. So you know what, Ron? You would be a perfect candidate for a non-collectible status. You have to go after them and explain to them. If you just let them start sending you certified letters, they just take the money. So what I'd suggest you do is give us a call. We don't charge to help people with this. 632-7886 or email me through egtax.com and we'll help you, okay?
Yeah, so you think I got a shot at this?
I know you do.
Yeah.
Okay?
I met you years ago, Esther.
Well, I can't wait to talk to you again, Ron. Have a nice Easter.
Oh, you too. Bye-bye.
Bye-bye. I'm Esther Gulius, the tax lady from EG Tax. We want to help you at EG Tax. Our offices are open all week. If you need us, our email address is egtax, our website, egtax.com. Till next week, I'm Esther Gulius, the tax lady. Have a blessed Easter. Bye-bye.